there will be more of an adoption of gold. And a lot of this de-dollarization has far more to do with the sanctions on Russia than the U.S. money printing. Okay, because if you can deal in some sort of BRICS-backed currency or gold, that's where you want to park your excess reserves, or maybe even crypto at some point. That can happen, but the scale with which something like that would need to happen to replace the U.S. dollar is logistically impossible for gold, right? Do I think gold is and because of that, I'm extremely bullish on gold, because we will see zero fiscal restraint until it's almost too late for our U.S. government, until it seems like the dollar's on its very, very last legs.
MichaelLee, founder of MichaelLee Strategy, forecasts significant upside potential for gold in the coming years, possibly reaching $5,000 per ounce by 2027 and 2028. However, this projection hinges on factors like fiscal policy, interest rates, and the strength of the U.S. dollar. Despite the consolidation of the U.S. dollar, gold prices have rebounded, albeit with potential upside limitations, as traders await key U.S. inflation data. Fed Vice Chair Philip Jefferson's call for maintaining interest rates until inflation eases further has tempered upward pressure on gold. However, escalating tensions in the Middle East could bolster safe haven flows, supporting gold prices in the near term. Lee attributes the bullish outlook for gold to the U.S. government's limited fiscal restraint and willingness to weaken the dollar to sustain global trade. Meanwhile, negotiations to pass necessary appropriations bills for next year's government funding face gridlock, with House Republicans demanding spending cuts and unrelated concessions. This political impasse complicates fiscal policymaking and could impact gold's trajectory. The current geopolitical landscape, particularly sanctions on Russia, accelerates the trend towards de-dollarization, reinforcing gold's appeal as a stable asset and hedge against inflation for central banks and investors. Geeta Gopinath, first deputy managing director of the IMF, warns of a potential retreat from global economic integration due to countries reassessing trading partners based on economic and national security concerns. This geopolitical shift underscores the importance of assets like gold in uncertain times. As global economic dynamics evolve, the role of gold as a haven and hedge against geopolitical risks becomes increasingly relevant, shaping investment strategies and market sentiment. Join us as we delve into MichaelLee's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
My opinion is to avoid U.S. power and U.S. sanctions. Okay, you on this scale of global trade, like you cannot trade $1 trillion of gold in a day, right? And there's a much greater fluctuation in that. And then look, U.S. inflation is high, but it's not 5.25%. So you're from a pure logistical standpoint, there is nothing easier, safer, and that is going to pay you a yield above inflation, like the short-term U.S. treasuries right now. And yes, there will be more of an adoption of gold, and a lot of this de-dollarization has far more to do with the sanctions on Russia than the U.S. money printing. Okay, because if you can deal in some sort of BRICS-backed currency or or gold, that's where you want to park your excess reserves, or maybe even crypto at some point. That can happen, but the scale with which something like that would need to happen to replace the U.S. dollar is logistically impossible. Okay, for gold, for gold, right? Do I think gold is and because of that, I'm extremely bullish on gold, because we will see zero fiscal restraint until it's almost too late for our U.S. government, until it seems like the dollar's on its very, very last legs. We just broke through previous all-time highs and made a meaningful breakout, and our last move was from 2008 to 2011. So you have to imagine, if we follow historical trends, we've moved somewhere on that 3-year, that 2.5, 3.5-year trend line, where it takes it to get that breakout from when we went from approximately 820 2008 to 2000 in 2011, right? And if you look at the previous cycle breakouts, I think we went from 250 to 800 around the time towards the end of towards Y2K. That's when we made that breakout there, and so I see that sort of historical trend. That's what I'm basing it on, that it's a 2.5x, similar to like what you see with the Bitcoin, coinciding with the halving that you see a triple of the previous high. If you look at what they're doing in Washington, it makes sense to me that these historical trends will hold.
Gold price moves, but you're seeing $5,000 gold in the next 3 years by what, 2027, 2028?
Geez, it is 2024. Wow. Yes, that's a timeline I'm seeing. Unless, look, things could change that. If somehow Washington, D.C. was to show massive fiscal restraint, and we did see much higher interest rates and a much stronger dollar, maybe that could derail it. But if you read about what the Trump people want to do, they want to weaken the dollar over time to help with the global trade standpoint. I think either administration is, either chance of an administration is bullish for gold. I mean, that's my opinion. And it's a little bit wonky to think that, like, if the dollar loses reserve currency status, that would actually be bullish for the dollar over the long run. I'm sure in the middle, it'd get pretty hairy, but you need to show fiscal restraint if you can't keep printing unlimited money. And right now, we can keep printing unlimited money for a long way in front of us.
Lee highlights discrepancies between initial manufacturing and economic indicators, historically reliable predictors of a recession, and the actual economic trajectory. Despite this, signs of improvement emerge, including a potential turnaround in manufacturing, inventory restocking, and positive GDP projections. However, the Apollo chief economist warns that current economic strength is fueled by high debt levels among U.S. consumers and corporations, foreshadowing a potential hard landing in 2025. Moreover, concerns persist regarding the accuracy of official labor market statistics, with discrepancies between household and establishment surveys raising doubts about the true state of employment. The unemployment rate may be higher than reported, amplifying economic data uncertainty. Recent data showing a rise in Americans filing new claims for unemployment, benefits to the highest level in over 8 months, further underscores the cooling labor market. This serves as additional evidence of economic slowdown, warranting close monitoring of future developments and their implications on overall economic health. Let's get back to the interview.
Just underestimated the amount of government spending. Like the official deficit number was like 1.7 or 1.8 trillion, but there's a lot of accounting gimmicks. So we had a $2 trillion deficit last year, which is just mind blowing. That and the higher end consumer is a lot more resilient than I anticipated. And I think the lag effect of the Fed rate hikes in this cycle is much greater and much longer, combined with the fact that you going into this rate hike cycle, you had a lot of these wealthier consumers, massive companies sitting on piles of cash. And so people sitting on cash in a rate hiking cycle, it's stimulative to them. It's not restrictive. And those that are levered up, unless you need to roll over debt or take out new debt, these rate hikes mean little or nothing to you. So the lag effect of these rate hikes combined with the excess government spending and my underestimation of the high-end consumer, along with this AI boom that's going on, all three of those contributed towards my incorrect call. And I think we've kind of surpassed the trough in manufacturing. In my and everyone else's defense, leading economic indicators were down like 17 out of 18 months. I mean, things like that have only happened in like the 2008 financial crisis. And if you look at how horrific manufacturing got in the manufacturing surveys, how bad housing looked, all these sorts of things have been very accurate recession indicators historically, but this time they just weren't. And I think we've already surpassed the trough in manufacturing. If you look at rail cars, they're starting to peak. And if you look at inventories, we're about to set along a restocking, and then the Atlanta Fed GDP now, which has no predictive capability. It's not the Atlanta Fed making it up. They're just taking in data as it comes in and annualizing it out for the rest of the quarter. That's up around 4%. So look, I think the employment situation is grossly overstated. I think the rosiness around the economy talk is a little bit overstated, not tremendously, but the worst is behind us. So,
well, hang on. The worst is behind us. So, what is your outlook now then?
Yeah, like slow growth, unless we have dramatic policy change in Washington D.C. from the presidential election. Slow, benign growth, large deficit spending to support the economy, and then just we're growing, but there's no real like the thought of like a real 3.5-4% GDP is a pipe dream, but declining economic activity year over year, quarter over quarter. I don't see that. I don't know that the data in the labor market is quote unquote worsening. I think the Bureau of Labor Statistics, their modeling, you can't compare it to pre-COVID numbers. When you have a jobs number that beats estimates only to later be revised lower that would have missed estimates 12 out of 13 times, what you have is a statistical impossibility. I don't know that they're cooking the books or they're grossly inaccurate, but the difference between the household survey and the establishment survey, and then when you look at the number of people working, like these are all wildly different numbers. With the household survey that we see, the establishment survey that we hear about every month, that the unemployment rates you're quoting and most people look at, I just think they're very inaccurate. I think the unemployment rate is somewhere between a point to 2 points higher than where we are. And maybe it gets a little weaker. Maybe it gets a little stronger. Historically, 5% was full employment. I think we are somewhere near there in somewhat of a benign economy. I do think we see at least one rate cut before the election because I think the Fed is an ultra-politicized institution.
Despite the potential upside for gold, fiscal policy uncertainties, interest rates, and geopolitical tensions underscore the need for caution in investment decisions. Moreover, concerns persist regarding the accuracy of economic data and the state of the labor market, with discrepancies between indicators raising doubts about the true economic picture. Recent data indicating a rise in unemployment benefit claims further underscores the challenges facing the labor market and the broader economy. How do you perceive the current economic landscape and its implications for gold and other investment assets? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.